Welcome to the daily update, where I'll go over the action in the market for Tuesday, February 6th, and then we'll see how things look for Wednesday, February 7th. A pretty slow day. We saw a decrease in volume. There wasn't any economic data that was released. The market just kind of floundered a little bit sideways, so we didn't really see much of a move. We did close a little bit higher, and that was thanks to some late day buying that helped the S&P 500 to climb just a little bit, but really not an awful lot was decided. I have a few extra charts to show you as I go through the video. These are longer term things that I'm seeing just to be aware of. Some of them are positive, some of them are negative. Just take this, and that's why we watch this every day, is to see the story unfold with each passing day, instead of saying, oh, we see this right now, we better make all of our decisions. Well, we wait to watch things unfold before we actually take action. At least that's my approach to things. So let's go back and talk about what happened. Right at the open, we had a slightly higher open with prices not reaching R1. So we never even got up to the R1 level at 49.61. Then we fell back to the unchanged level and also to the daily pivot. They were pretty close to each other. The daily pivot was at 49.39. As the day went on, we just chopped sideways. And by the end of the day, we ended up going up just a little bit to end positive. We were up 0.23% on below average volume, so it did taper off a bit there. We are positive with our technicals. We still have an overbought condition that we're dealing with. We also have some longer term negative divergences that we're keeping an eye on. There's also some shorter term weakness that could be coming into the market. We're also getting close to that 5,000 level with the S&P 500, and that may be some kind of a milestone that the market wants to achieve. It's a good round number. It makes for great headlines. The financial media loves that kind of a thing. We'll have to see if that can happen, and then what happens after that if we even get to that level. Just to give you an idea, way back when I first started in the early to mid 90s, they kept wondering, is the Dow ever going to get over 4,000? We would get close to that and then back off, close to it and then back off. And then, my gosh, you would have thought it was New Year's Eve when we finally closed above that level. Then, when we had the big downturn after the dot-com bust, the Dow lost, I think, 80% or something like that. And it took 15 years to get back to its previous level. And the day that happened, you would have thought it was a big party again. So the financial media really likes to do that. Now, I don't watch the financial media, so I don't really have an idea what they're talking about. I mainly just look at the charts, and I follow a few podcasts and some things on Twitter, and that's pretty much it. I let the charts tell me what's actually happening. We're also keeping an eye on all the different geopolitical events, but as I've been saying, they're not really having much of an impact these days. Some comments that we can make: the Dow and small caps did outperform. So small caps had a fairly good day. They have a long ways to go to get back to any kind of a January effect now that we're in February. And the Dow ended up having a pretty good day as well. And then the New York Community Bank that I pointed out over the weekend, they last week fell like 11% in one day. In this session, they ended up falling over 22%. So we're keeping an eye on that, wondering, again, is this an isolated case? Is this just this bank, or are we going to start to hear about other banks that are having some problems? And I have a chart to show you of that later. On a short-term basis, we have pretty much our usual suspects that are looking extreme positive, or you could say overbought. The Williams percent are the CCI 14 and 20 and the stochastics. They've been on there for quite a while now. Intermediate term, we're still keeping an eye on the PMO oscillator, which is looking pretty extreme, and a lot of our oscillators, but we're still seeing that mixed picture where some of them are falling below their moving averages, some are on top of their moving averages. We have the NASDAQ 100 bullish percent index, which is still extreme. The money flow index, that's a new addition to the list. The boom indicator based on 50 periods. You notice in the short term, the 20 period, that's dropped off the list, but the 50 is still there for the boom indicator. The S&P 500 new highs, new lows study based on 10 periods. We don't have any long-term overbought conditions now. The 150 and the 200, they've actually pulled back down enough and they're not necessarily looking extreme right now, even though you could say they're positive, but because they've been declining, that's a little bit negative. This is the same scenario that we've been working with pretty much for the last few months, that the Fed looks like they're done raising rates. And at some point in 2024, they will possibly look to cut rates. They took March off the table. Now it's looking like May might be the next possible time when something like that can happen. The dollar was down and interest rates were also down. We came down to the 4.09%. We still are above 4%, or just a week ago, we were under 4%. We shot up and then we pulled back just a little bit in Tuesday's session. We still have the yield curves that we've been following anywhere from a year and a half to 2 years that remain inverted. Sentiment didn't change. We're underneath that 75 level where we get to extreme positive. So a solid update could carry us into that extreme positive territory. Or to look at it another way, we hit 75 already and we could be coming down from that depending on which way the market moves. But we're coming in at 73 right now. Our trend is still positive, but we're still below the moving averages. We're kind of on top to underneath with both the short and intermediate term ADX indicator, but both are still above 20, suggesting that we are in a trending environment. The green line still continues to be on top for both the short and intermediate term, so we would still default to positive. I'm keeping our bias at mixed because we had kind of a down day on Monday, kind of an up day on Tuesday. The market is really indecisive, and without a lot of big economic reports coming out this week, there's going to need to be some kind of a catalyst. Now, it doesn't have to be an economic report. It could be some kind of geopolitical event, or it could be just some big money player coming in and doing a lot of buying or selling that could really take things one way or the other. And I'm keeping our momentum at positive because the last 2, 3, 4, 5 days have been more positive than negative. Some economic reports that came out were none. This is very strange. And what's even more strange is we're not going to have any economic reports coming out in Friday's session either. To get one day with no reports is strange, but 2 days within the same week is even more strange. So I don't have any charts to show you there. Couple of charts from Isabel Net blog charts. Here's the latest reading from GDP from Goldman Sachs. The takeaway from this is the gray columns here, or bars, you could say, they're positive. And even though they're coming down with their forecast with GDP, it's still positive. Or if you look at the black diamonds, they're actually going up a little bit. So the general consensus is tending to be more positive than Goldman Sachs themselves. But again, you look at both of these and they are positive going forward. One of the definitions of a recession, one thing that we use is that there are 2 quarters back to back of negative GDP. And for right now, nobody's really anticipating that. This is the probability. This is looking at just a little bit different way, where just at the end of December, there was a 90% chance that they were going to cut rates at the March meeting. That's dropped all the way down to 20%, actually under 20% at 19.2%. With the Fed meeting last week and Chairperson Powell pretty much coming out and saying, we don't know yet if we're going to do that. It's not looking very likely. We need to see more evidence. That's when this really started to drop off. And so you can pretty much take the March rate cut idea off the table completely since it's dropped so far in the probability rating. Then looking again at the Magnificent Seven, they're 29% of the S&P 500 index and 22% of earnings as of the 2nd of February. And it's showing they're 29% overall when you weight them. And so that's why we keep an eye on them. That's why I mentioned the mega caps, because if they're having a good day, the index is having a good day. And the inverse of that is also true. And then the next 12 months net income, they're also seeing that going up 22%, at least into the future for right now. And so this is where a lot of the strength is coming from these days, and that helps the indexes. It may not help individual stocks that you might own, but it is helping to keep the indexes together for right now. Then this is the idea of a soft landing or a hard landing. Well, lately there's been a little bit of talk of no landing, that we're not really going to land. We're just going to kind of keep going. And This looks at different bubbles that we've seen over the years. If you go way back into the 70s and into the 80s, if you remember, gold was all the rage, and then it came back down. Then in the 80s, that's when Japanese stocks hit their highs, which, what is it, Goldman Sachs? I think they think that we're going to surpass those highs this year that we haven't been able to get back to since 1989. This is about the time when I started getting in the market from the 92 to 95 area. And the big crisis that I remember was the whole Asian currency crisis, and long-term capital, which was a huge hedge fund at that time. They really started to put some pressure on the market and led to almost a global meltdown there. Then here's the internet bubble that we had from that topped out in about the year 2000. Then the housing market, when you get people that don't know anything about real estate suddenly flipping houses, you know you're in a bubble at that point. That Then China became kind of all the rage for a while. Then we get into 2013 through 2016. That's when the biotech stocks look like to be the next latest greatest thing. Then ARK kind of came and hit the markets, and everybody was all oohing and on over that. And I've already done a video a few months ago about people that got in at the very top and have lost a lot of their money and what they could have done ahead of time to protect that. Then we get the cryptocurrencies coming in, and then the FANG index, which that's what really led things lower in 2022. And now we're looking at AI as being the next big bubble. So I'm taking a little longer with this because a lot of the charts that I go through today are things that I've been repeating for the last number of days. Then we look at the average cumulative S&P 500 returns, and this is kind of interesting, going from January 1988 up to the current day, where if you just invested in any day whatsoever, these are your returns, and they're the gray areas. And you would have done well because the market has a tendency to go up over a period of time. That's why I like to think of myself as a realist when it comes to the market. There are times when it goes up and there are times when it goes down, but it's going to go up a lot more than it's going to go down. And so, and there's folks that no matter what's happening, the next crash is right around the corner. No matter how much we're going up, people are getting ready to short when there's really no evidence of that, when the statistical probabilities are that we are going to keep going up at some point. And that's what happens with the stock market, is betting on the future and seeing growth going forward. But there are some really painful times that come along. But if you invested while we're making a new high, and this is what I do, I buy into strength, I sell into weakness, your returns would have outdone just by buying at any particular time. Not as great as you might think here, because this involves a little bit of market timing. But what I like to do is look at what's really happening in the market. You'd never go against the trend, and then you can use that to position yourself in either a positive or a negative way. And this doesn't take into account the fact that you can make money when the market goes down as well. So, all right, there we go. Then this is the ISM manufacturing. They think here, according to Bank of America, that it's likely to rise going forward. It has been showing some improvement where we're seeing the manufacturing PMI. That's the dark blue line. It's coming back up, but it's still negative. And then the new orders are actually starting to look a little bit more positive here, and that should help the dark blue line to actually perform a bit better. Okay, here's our intraday chart. Not an awful lot to talk about. We had a bit of a higher open, never got up to R1, came back down, danced along the unchanged level in the daily pivot. Pretty much for the rest of the day, we tried to go up a few times only to come right back down, but we did close a little bit higher when things were said and done. Here's the intraday chart. Again, not a lot to show here. The initial overnight session was pretty much flat. We were chopping around before the market opened. Here's the cash session, and we're a little bit more positive in the initial overnight session. And we're still seeing the blue line above the red line. So growth is still hanging in there. Even though on an end of day basis, it ticked down, it's still holding up for right now when we look at the intraday chart. And it did decline when we look at the intraday ratio here. So that's not as positive as we'd like it to be, but it's not necessarily falling apart right now either, at least yet. And then looking at small caps, this is interesting, where we're seeing small cap growth really starting to break out compared to small cap value. This broke out in yesterday's video, and that breakout is still continuing. That could give some support to the small caps. The mid caps, it ticked down just a little bit, but in the bigger picture, they've been a little bit more positive when we look at growth to value for them. Our end of day charts, we were down with growth with the large caps where we were up with value, but we did outperform with the mid caps. We were positive with the small cap growth, but it was up less than half of what it was for small cap value. So here's our end of day chart for the S&P where we did tick down. We have been showing some improvement. We're still working off of a longer term downtrend here. We want to see this continue to go up if we're to remain more positive, because as we were coming down, we were seeing this negative divergence, which could be putting some pressure on prices right about now. We're also keeping an eye on discretionary versus staples. We ticked up just a little bit with the ratio, but we're still seeing a longer term negative divergence with this chart. Keeping an eye on our trend, we're pretty much right on top of the moving average, but we're above 20 and the green line is still on top. And we're seeing pretty much that same thing in the short term, right on top of the moving average. The green line is on top, so we're still positive there. Longer term, we did drop off with volume, but for the most part, we've been above average with volume lately. Here's sentiment where we tick down just a little bit to sideways with the Ulcer Index. We came down a bit with the VIX with the line chart as well as the bar chart. And we're seeing volatility really starting to drop off when we look at the VIX of the VIX, both with the bar chart and the line chart. This could be getting down to a low reading again, which sometimes marks a bottom as far as volatility is concerned before it actually goes over and affects the VIX itself. We did go up with the equity put call ratio. So we saw an increase of hedging, and we're continuing to go up with our 5-period. This is a little bit of a warning sign. More positive, in a more positive environment, we want to see this going down. It has been going back up over the last few sessions. And we're still keeping an eye on the VIX to S&P 500 correlation. We're still at this extreme reading where a lot of times when we finally go up to a point and top out and start to come down, at least according to this study, that typically will be negative for the market in the short to intermediate term. So we want to keep an eye on that. We're also keeping an eye on the skew index. It came down just a little bit after it came up into this red area, but we're still in that extreme area. This is a little more, we have to interpret this a little bit differently, because just because we're getting a high reading is not necessarily negative like the previous chart. This could be either positive or negative. Our advanced decline line studies, we ticked up just a little bit based on price as well as volume. We're hanging in there for right now, well above the moving average. And we saw more new highs than new lows that are being generated, but we are starting to go down with the 5-period and we're turning down with the 10-period. That's a little shorter term negative divergence. And we ticked back up with the advanced decline ratio. We're still above 0. That's positive. And accumulation distribution continues to advance. That's also positive. And the Chaikin money flow continues to show some improvement when we look at the moving average. That's positive. And the Chaikin oscillator continues to advance as well. The advanced decline line for the NYSE did tick up. It actually outperformed the S&P 500, where the S&P didn't go anywhere. We saw the broader market actually perform better. So we turned back up a little bit with the NYSE common stock, up a little bit with the S&P, the mid caps, and the small caps, but the small caps are still below their moving average. Here's the daily chart where we came up to this pivot level now. This could be providing some kind of overhead resistance. We want to be able to break through that if we're going to turn more positive, and we are getting rather close to that 5,000 level. On the bottom, we did drop to below average with volume. We're still extreme positive with the Williams percent R, the CCI 14, and the CCI 20. We did turn back up slightly with our 20, 50, and 200 period moving average studies. The force index is still above the midpoint and positive. And we're still extreme when we look at the short-term stochastics, intermediate short-term, and the long short-term. And we're still right on the border between the +2 and +3 when we look at our standard deviations chart. So we're not necessarily extreme there. We're still positive with the balance of power. We're positive with the go, no go. We're positive with the highest high value. The TTM squeeze is switched back to a lighter shade of blue. So that's switched back a little more positive. We're still looking positive with the ease of movement. The Arun really hasn't changed, but it is remaining positive. We're still seeing that negative divergence with the McClellan oscillator for the S&P. It came back up, but it's still below zero. As we were going up with the S&P, the McClellan oscillator was going down. So when we look at the summation index, we continue to decline based on price and volume. That's also another negative divergence. The S&P was going up as both of these indicators were declining. And the NYSE McClellan oscillator also showed some improvement, but is still below zero. So we continue to decline with the summation index for the NYSE, and we're actually declining a little faster based on volume. We're still dropping below zero with the Swenlin trading oscillator based on price and volume. That's more negative. And we're just chopping more or less sideways with the PMO. We're positive, but we're above this line here, so we're extreme positive. But when we break it down based on price, we're still below the moving average and declining, and we're right on top of the moving average with volume. We're not showing anything extreme here with the PMOs that are rising. We saw a bit of a decrease with the buy signals, and we're no longer extreme with the PMOs above zero. We continue to be neutral with the Elder's Impulse system for the S&P, but we're still positive with the parabolic SAR. The slope oscillator is right on top of its moving average. The MACD is looking a little more positive and is a bit above its moving average. So in the short term, we have our short-term oscillators pretty much on top of their moving averages, and both could be still at least interpreted as being extreme positive. We're positive with the MACD. We're a little bit above the moving average with the PMO and PPO, where we continue to be positive in our longer term with our longer term oscillators, the TRIX and the KST. And we're still above all the plotted moving averages in the moving average tree. If we do see some kind of a decline, we're going to be watching the 20-period moving averages. We continue to decline here with the bullish percent index. This is another longer-term negative divergence. You notice we topped out here right at the end of 2023, and the S&P has been going up as the bullish percent index has been coming down. We also declined a little bit with the NYSE bullish percent index, but we're still above 50. Another thing to keep an eye on, we're declining with the NASDAQ 100 bullish percent index, but we're still above 70. The money flow index did finally kick into an extreme positive reading, and we are going up with the ultimate oscillator. The vortex continues to be positive. We turned up just a little bit, and we're not extreme with the RSI based on 14 as well as 9 periods. We're still positive with the on-balance volume. This is another area that I'm going to point out right after this, another study put out by Sentiment Trader. We ticked back up just slightly with the 200-period moving average study for stocks in the S&P. We're also declining with the 50-period. But this was posted on Twitter or X, whatever you want to call it, by Jason Gepfert, who he created this site called Sentiment Trader, which is a very good site. And he says, man, this is weird. The S&P is, as of the time he posted this, it's within 0.35% of a 3-year high. And that being said, fewer than 40% of the stocks are above their 10-day average. Fewer than 60% are above their 50-day moving average. Fewer than 70% are above their 200-day moving average. Okay? He says, since 1928, that's only happened once before, and that was August 8th of 1929. Now, I'm not saying we're going to have a stock market crash, but it was in October of 1929 when we had the big famous stock market crash. Now, the market could repair itself. This could go on for a period of time. We don't necessarily have to freak out right now, but this is something that we want to be aware of. The copy curve is still positive here for the momentum with this indicator. We're coming back down with the Sean trend meter after being a really extreme positive. We're no longer extreme with the boom indicator, measuring how far away we are from the 20-period moving average. We're still extreme when we measure how far away we are with the 50-period moving average, and we continue to hold up with the distance to the 200-day moving average. We're still looking okay based on our trend. The Heiken Ashi is still looking positive. The Kegi is still pointing down, but with the black bar, that's positive. The Renko chart is positive, and the 3-line break is positive. Then I don't have any longer term charts to show right now because I was really focusing on those longer term moving averages. And we need to get a handle on the short term and then see how that bleeds into the intermediate term before we can really adjust any kind of position in the long term, because we're still positive there. Looking at our different indexes, the S&P to equal weight, where the equal weight did outperform, and I have another new chart to show you there, where we actually came down just a little bit with the ratio. That means that the broader market outperformed the mega caps. And here's the new chart. Up on top, we have the S&P 500, which is back and close to all-time highs. And this is the equal weight to S&P 500 ratio. So when this is going down, that means the broader market is underperforming. But we can see this happening for quite some time. Even though we were going up in 2023, that was the mega caps. And when we see the mega caps outperforming, that's when this ratio declines. Near the end of 2023, we saw this coming back up, but lately we've been seeing it come back down. Looking at the Dow, we did not set a new all-time high, but we were up over 1/3%. We're still neutral with the Elder's Impulse system for the diamonds, and we pretty much didn't move at all with the NASDAQ, but we didn't really break down either. And we're still in no man's land when we look at the Fibonacci retracement levels. That would be another confirmation. One of the major indexes, well, of course, we have the small caps and mid caps, but the NASDAQ is not back to creating an all-time high yet. It's the NASDAQ 100, the Dow, and the S&P 500. It would be give us more confidence if the other indexes could come back and set all-time highs as well. As unlikely, as illogical as that may seem right now. Looking at the NASDAQ 100, it was down about 1/4%, but it really didn't move much either. And it switched from being positive over to neutral. When we look at the QQQs for the Elder's Impulse system, we're still right on top of the moving average with the PPO. So the NASDAQ 100 momentum is pretty much chopping sideways. The small caps ended up being up over 0.5%. We're coming back up, at least trying to anyway, get to the 50-period moving average. We switched from being negative to neutral for the small caps when looking at the Elder's Impulse system. We're above the 50-period moving average when looking at the Russell 2000 small caps, but we still have this resistance area here that the small caps have really had trouble going through. And we're still above this pivot level for the mid caps. So support has been holding there, and they were up almost 0.5%, but they still remain negative when we look at the mid caps for the Elder's Impulse system. This is a chart from Stock Charts, Chip. I forget. No, not Chip. David, somebody. He posted something on Twitter, and this, I've been trying to point this out myself, but this is another bigger, longer-term divergence. David Keller, that's who I was thinking of, where the S&P is making an all-time high. We've not been making all-time highs with the mid caps, and we're actually negatively diverging with the small caps. This is something that, again, I've been trying to point this out, but this gives you a chart of that just to see it in a bigger picture. I usually cover this in the weekly video. The FANG index was down about 0.5% and not setting an all-time high, but it's still positive. And here's another chart. We look at the staples to tech ratio. And when we were really going up in 2020, actually after we hit the bottom in 2022 and started to see a bit of a bounce, we see the staples really underperforming the tech sector, and that's still continuing to happen. So this is another area that we want to keep an eye on. When folks are getting very defensive or they're concerned about the market, they're going to be dumping tech and getting into staples, which means this ratio would really go up the way we saw right at the end of 2021 going into 2022. Then we saw a reverse of that, which helped the markets to really recover in 2023. So I won't show this chart every day. We'll just bring this up probably in the intermarket analysis video. The financial sector was up 0.21%. It's still positive there. This is the New York Community Bank chart, where just a week ago they were at 10.5. Then they dropped all the way down to between 6 and 6.5. Now they're falling down into the 4 region right now. Now that's one thing if it's just this bank that's going to be going through these problems. The concern is, are other banks going to start to come out and say that, oh, we're having problems also? The dollar ticked up just a little bit, or it's been recovering a little bit lately, but it's still in a longer term downtrend. We were down with the 10-year based on yield. We were up with the 10-year based on price. And then looking at our growth to value ratios, we ticked down just a little bit with the Qs to S&P. We're just about down to the moving average. We're still seeing this negative divergence between discretionary and the S&P. We turned down just a little bit when we compare large cap growth to large cap value, but it is above the moving average. And so we're still hanging in there with the large caps, the mid caps, and the small caps are kind of shining a little bit right now. That could be something positive if we can see some follow through going over into the index itself. We're still extreme positive with the 10-day average of the S&P 500 highs minus the lows. We're still positive with our broad market measure of the highs minus the lows. And we're still going up with our S&P to utilities ratio, which could give support to the S&P. A lot of times when this is going up, the S&P is going up as well. All right, so what's our outlook for Wednesday? The technicals are positive, but we're still having to ask this question. Are we seeing some weakness here? Nothing really got decided in Tuesday's session. We're still positive, but we're still seeing some potential areas that could show some weakness coming into the market. We're going to get the MBA Mortgage Applications Index and Consumer Credit in Wednesday's session, and then we want to keep an eye on the different geopolitical events. Then on Thursday, we're going to get weekly jobless claims. That's probably the biggest report, and then we won't get any in Friday's session. Seasonally, for February 7th, we're neutral to positive with the Dow, where we're neutral to negative with the S&P and NASDAQ. But we are positive when we have an up January, at least throughout February. This chart says that we tend to look positive going forward. I've tried to update this. The green line is where we're at right now based on the Carson research. And then we do see some weakness when we look at the Stock Traders Almanac statistics as we get through about into the middle of February, into maybe the latter part even of February, into about the middle of March. And then I don't have an update of this yet, but we're coming into February now where this tops out anywhere from about a third to halfway through the month before we do see some weakness. We follow the green line. That's when the sitting president, as far as we know, is running for re-election. And then this, I showed in yesterday's video that February is usually weak. Even though it's part of the 6 best months, it tends to be the weakest of the strongest months. And we'll be in Wednesday's session, which tends to be the most negative day of the week. And then we'll be on the 5th trading day, where we do see a little bit of weakness here when we look at the S&P during an election year. So our scenarios, not going with the downwind yet. We can make all these cases for negative divergences, but until we see any kind of follow through with price, we really can't go with that yet. If anything, our charts are still looking more positive, but we want to be aware that weakness could be coming into the market. And we're not going with the sideways scenario for right now, because even though the ADX is below its moving average, it's still above 20. So the warning signs, the risk on posture is still chopping. The equity put call ratio based on 5 periods is still going up. And I have this both on the warnings and the positive slide. Our oscillators are mixed after being extreme positive. The McClellan oscillators and summation indexes are negatively diverging. That's more intermediate term, a concern that we want to just keep an eye on. Small and mid caps are negatively diverging from the S&P. That was the chart from David Keller that I showed you. The bullish percent index for the S&P is now declining after it had been extreme positive. The transports, and I'm not even showing those charts because that's more long-term. They are still negatively diverging from the Dow, and we're not really sure about the momentum right now for the NASDAQ 100. The positive signs, even though we ticked down, growth has been improving over the last few trading sessions, and we're still kind of mixed here with our oscillators. The parabolic SAR and vortex charts continue to be positive. The bullish percent index for the NASDAQ 100 is still above 70, even though it declined, and that's considered extreme positive. The Copic curve is positive, small and mid-cap growth, and we're seeing a little bit of breakout with the small caps, which is rather encouraging, and mid-cap growth is holding up for right now. The financial sector continues to be positive in spite of the banking news that has been coming out. So our conclusion, we're positive, but we still have to ask, is weakness developing? That's what we're watching for in the short term. And then we'll see, is that going to bleed more into the intermediate term if that weakness ends up following through? But we need to see confirmation based on price. In the long term, we still continue to be positive. Thank you. I really hope you found this helpful. I hope you have a very good day, and I will talk to you in the next video.